The night your bank decides whether you get saved or left behind, nobody announces it. There's no siren, no headline, no breaking news banner on your phone. There's just a spreadsheet, a conference call, and one number that quietly answers the only question that matters. If this bank fails, who eats the loss? Because in modern banking, rescue isn't a moral choice. It's a loss allocation problem. And the number that decides where you land, saved or sacrificed, is not the stock price, not the CEO, not even the size of the bank. It's the capital ratio. More specifically, common equity capital measured against risk. A number so boring it feels harmless. Until you realize it is the bank's airbag. And airbags don't prevent crashes. They decide who survives them. Let me take you inside that room where the decision happens, without jargon, without lecture, and without pretending the system is nicer than it is. Picture this. A mid-sized bank looks fine from the street. Customers still tap cards. ATMs still spit cash. The app still loads. But behind the scenes, there's a run that doesn't look like a run. Not people lining up outside. Just corporations moving deposits with 2 clicks. Money leaving at machine speed. The bank's treasury team is watching a screen with outflows stacked like falling dominoes. Their options are shrinking by the minute. They can borrow. They can sell assets. They can beg for a lifeline. But every option depends on the same thing. How much real loss can this bank absorb before it's not a bank anymore? That's capital. Capital is the layer that takes the hit when reality shows up. Not deposits. Not confidence. Not marketing. Capital. Now here's the uncomfortable part. Most people think capital is the cash the bank has. It isn't. A bank can have plenty of cash today and still be insolvent tomorrow. Capital is the gap between what the bank owns and what it owes after losses. It's the part of the balance sheet that belongs to shareholders, the shock absorber. And the moment losses eat through that buffer, the bank stops being a bank and becomes a problem that someone else must contain. So why does this one number decide whether you get saved or left behind? Because every rescue, every merger, every backstop, every weekend deal is built around one calculation. How big is the hole? And who can legally be forced to fill it? To see it, you need a simple mental model. Imagine the bank as a building with floors. At the bottom is equity, shareholders. They own the building, but they also take the first hit if the foundation cracks. Above them are subordinated bondholders, people who lent money to the bank in a form designed to absorb losses after equity is gone. Above them are senior bondholders. Above them are uninsured depositors, large accounts that exceed the insured limit. And at the very top are insured depositors, ordinary people whose money is explicitly protected. When the building shakes, the lower floors collapse first. That's not opinion. That's how the contract is written. Now, regulators and governments don't start by asking, who deserves help? They start by asking, if we let this fall, will the collapse climb upward fast enough to hit the top floors, ordinary depositors, and then spread to other buildings? If the answer is yes, you get saved. If the answer is no, you might be left behind. That's the logic. Cold, mechanical, predictable. The capital ratio is the number that tells them how much shaking the building can take before the collapse reaches the floors they care about. So let's define it without the textbook. A capital ratio is basically how much real owner money is in this bank compared to the risk it has taken. If the bank makes risky bets, it needs a thicker airbag. If it holds safer assets, it can survive with less. But here's where the hype versus reality comes in. Hype says, banks are safe because they're regulated. They have capital requirements. Reality says, banks are safe until their risk model says they are. Because the capital ratio depends on something that sounds scientific but is partly political. Risk weights. Risk weights are the system's way of saying, this kind of asset is probably safe so we'll treat it as less risky. Treasuries get a low weight. Some mortgages get a moderate weight. Certain loans get higher weights. And banks structure their balance sheets to look healthy under the rulebook. That's not fraud. That's incentives. And it creates a problem you only notice during stress. A bank can look well capitalized on paper while sitting on losses that haven't been recognized yet. Because accounting lets some losses hide in plain sight. You've probably heard the phrase, unrealized losses. Here's what it really means in human language. The bank bought something at one price, the market now values it lower, but the bank doesn't have to admit the loss unless it sells. So the bank says, we haven't lost anything. We are just holding it. And in a calm world, that can be true. But in a run, holding becomes selling. And unrealized becomes real in a single afternoon. Now watch how the capital ratio turns into destiny. A bank is facing outflows. It needs cash. It sells assets. Those assets are underwater. The sale crystallizes losses. Losses reduce equity. Equity falling means the capital ratio falls. As the ratio falls, the bank looks weaker. As it looks weaker, more people pull deposits. As more deposits leave, the bank sells more assets. More losses. Lower capital. A feedback loop. This is the difference between a bank wobbling and a bank dying. And in that feedback loop, there's a moment where regulators make a choice. Not between good and bad. Between two bad options. Option 1. Let the bank fail and follow the legal waterfall. Equity wiped. Bondholders take losses. Maybe uninsured depositors take a haircut. Option 2. Prevent contagion by protecting depositors, forcing a merger, providing emergency liquidity, or in extreme cases invoking special guarantees. When do they pick option 2? When the whole threatens the system. And the simplest way to estimate the whole is the capital situation, not the PR statements, not strong liquidity position, capital. Now, if you're thinking, okay, so as long as a bank has a good capital ratio, I'm safe, here's the second uncomfortable truth. Capital doesn't protect you the way you think it does. It protects the system first. It protects insured depositors by design. It protects uninsured depositors only when they matter for stability. It protects shareholders last, which is exactly why shareholders care about it the most. So where does that leave you? It depends on what you are to the bank. If you're an ordinary retail depositor under insurance limits, the system is designed to keep you calm. Your money is politically toxic to touch. If you're a business with large balances, you're not just a depositor. You're a potential shock transmitter. Your treatment depends on whether harming you triggers a chain reaction. And that takes us to the one number I want you to remember, because it tells you what side of the line you might be on. Not capital ratio in general. The quality of capital. Because banks don't just have capital. They have types of capital. And in a crisis, only one type is truly reliable. Common Equity Tier 1. CET1. You can think of CET1 as the purest, loss-absorbing buffer. Common shares and retained earnings, minus certain accounting adjustments. It's the closest thing to real skin in the game. Other forms of capital, hybrids, subordinated instruments, can help, but they can also behave strangely under stress. Some are designed to convert, some are designed to absorb losses, some depend on triggers that might not fire when you expect. CET1 is the number regulators stare at when they're deciding whether a bank can take more pain without the building collapsing into the floors above. So the one bank number that decides whether you get saved or left behind is: how much real common equity does this bank have relative to the risk it claims to be taking? Because that ratio sets three things that matter to your life, not just to finance nerds. First, the bank's freedom to operate. If capital is strong, the bank can keep lending, keep functioning, keep meeting withdrawals without turning itself into a fire sale. If capital is weak, the bank's choices shrink. It becomes dependent on emergency tools. Second, the bank's bargaining power in a rescue. In a forced merger, a bank with adequate capital can negotiate terms. A bank with collapsing capital gets acquired on harsh terms or carved up or wound down. The people who get left behind are the ones sitting in layers the deal doesn't protect. Third, the political narrative. If the bank is clearly insolvent, it becomes easier to justify imposing losses on investors and certain creditors. If the bank looks solvent but illiquid, it becomes easier to justify a liquidity backstop and broader protection. That distinction, solvency versus liquidity, is where rescues are made. And capital is the anchor for that distinction. Now let's make this real with a story that repeats in every crisis, even when the names change. A bank grows fast in good times. Deposits pour in. Management celebrates strong growth. The market loves it. Analysts praise franchise value. The bank invests the deposits in safe-seeming assets. Government bonds, mortgage-backed securities, high-grade stuff. Then rates rise. The market value of those assets falls. The bank says it's fine because it's not selling. But then depositors leave. Not slowly, suddenly. The bank needs cash. It sells assets at a loss. That loss eats capital. Now every investor, every large depositor, every counterparty asks the same question. Is the capital buffer still real after these losses? If yes, you may see a rescue that looks gentle. Liquidity support, time to stabilize, perhaps a buyer on decent terms. If no, you see a rescue that looks violent, equity wiped, certain bondholders wiped, maybe uninsured deposits frozen or haircut. Unless authorities decide the spillover is too dangerous. That's the pattern. The hype is that modern finance is sophisticated and controlled. The reality is that it is still a confidence machine built on leverage. Capital is the thin layer that keeps leverage from becoming a death sentence. Now, zoom out. Why does this matter beyond your personal bank account? Because capital ratios shape the entire economy's mood. When banks fear their capital is at risk, they stop taking risk. They tighten lending. They pull credit lines. They demand collateral. They stop rolling over loans as easily. And suddenly businesses that looked fine, restaurants, contractors, manufacturers, start feeling a squeeze they don't understand. Not because customers disappeared overnight. Because bank capital became precious. When capital is scarce, credit becomes expensive. And when credit becomes expensive, growth slows, layoffs rise, and the economy pays the bill. This is why central banks and governments treat bank capital like a firewall. Not because they love banks. Because they fear what happens when the firewall fails. Now, here's the part that most explainer videos avoid because it feels too cynical. Capital ratios can be gamed without breaking rules. Banks can shift assets into categories with favorable risk weights. They can use models that reduce measured risk. They can hedge in ways that look safe until correlations rise. They can structure exposures to look diversified until stress forces everything to move together. So the capital ratio is not a perfect truth. It's a decision tool, a legal and statistical signal. In calm times, it's comforting. In stress, it's questioned. And that's why the final decision, saved or left behind, often happens over a weekend. Because once that number is questioned, time disappears. If you want one practical lens, without turning this into a checklist video, here's a simple way to think about your own exposure. Ask, in the bank's building, what floor am I on? If you're within insured limits, you're high up. You're meant to be protected. If you're above that, you're in a layer that may be protected when contagion is feared, but is not sacred by default. And if you hold bank stock or certain bank bonds, you're on the lowest floors. You are literally there to absorb the hits so others don't have to. That's the deal. You don't need to be a finance expert to understand the moral of this system. Your safety is not determined by how good the bank feels. It's determined by how the losses get assigned when stress arrives. And the capital ratio, especially CET1, tells the people in charge how close the bank is to that assignment moment. Now, one last twist, because this is where the story becomes uncomfortable again. Even if a bank has a decent capital ratio today, your fate can still change fast, because the ratio is backward-looking. It's measured using yesterday's valuations, yesterday's risk assumptions, yesterday's calm. In a fast-moving crisis, capital can evaporate in hours. Not because the bank committed obvious fraud, because the assets everyone agreed were safe suddenly had to be sold. And in markets, forced selling is its own kind of disaster. So here's the question you should leave with. When the next banking stress hits, and it will, because leverage always creates stress eventually, do you know which number the system will look at to decide what gets protected? And more importantly, do you know which layer of the building you're standing on when that number starts falling? Because the scariest part isn't that the system is unfair. It's that the system is consistent. It will save what it must to prevent contagion. And it will sacrifice what it can to make the math work. So if the one bank number that decides whether you get saved or left behind is capital, CET1, then the real question is, when that number is challenged, will the system see you as a person to protect or as a line item it can afford to lose?